For us, I guess we are counter-cyclical to a large extent. As I mentioned right at the beginning, we built this business off the back of the last crisis. We want to provide people with the opportunity to earn the best risk-adjusted returns in the good times. But we also want to provide people with the absolute safest place to store their cash in the more difficult times.
Hello and welcome to Homescreen. I'm Jim Safford and I'm today going to be joined by Kevin Cook, who is the CEO of TreasurySpring. This is a product that's been built to allow greater access to fixed-term fund money markets. So first, can you tell us a little bit more about yourself and how you came to found TreasurySpring?
Sure, yeah. So TreasurySpring was founded by me and two guys I've worked with since 2006. We've always worked together in fixed income markets, and for the last 10 years or so, we've worked together in the cash management space. We set up our first business in 2010, which was an independent fixed income advisory firm. And really, it was in that guise that we first started understanding some of the problems that existed in the cash management marketplaces in the aftermath, actually, of the last financial crisis. And we sold that business to an asset manager in 2013, ran short-dated fixed income there for a few years, but kind of over the course of what had now become 6 years, had realized that in order to solve what we perceived as being a pretty huge problem and a huge opportunity in the market, we really needed to do something in a tech-driven, product-focused way. And that led to the creation of TreasurySpring in 2016.
In what way is the use of the sort of products that you offer on TreasurySpring in some way sort of not reflexive to, but kind of well suited to this current environment?
Yeah, so I guess we feel like we learned a lot in the last crisis, mostly what not to do rather than what to do. But hopefully we've taken that through the platform and the products we developed to enable our clients not to end up making some of the same mistakes that we made last time round. And really what we learned was that things are always uncorrelated until they're not, and things are often liquid until they're not. And that till they're not can happen really vanishingly quickly. And so what we did at TreasurySpring was enable people the opportunity to truly diversify cash balances, to get some escape from the unsecured financial risk that is highly correlated, that is where most institutions have historically put their money. I say most institutions, really, if you look at what a large bank or a large asset manager or a large fixed income hedge fund does, that's not true. And really, that's sort of some of our lessons over the years have been working with clients like that in the financial sector, understanding how they invest cash, how they diversify, how they reduce risk, and then offering out, democratizing access, if you like, those access to those same products, but delivering it to anybody with kind of institutional levels of cash balances.
Okay, and so I guess the underlying notion there is that you need a certain level of access or a supply side sort of infrastructure in order to access these different types of fixed income products, of fixed rate products. Is that something which the product is hoping to address directly?
Yeah, absolutely. So one of the principal issues with investing in what we would call superior cash management investments from a risk perspective, so things like accessing directly the government in your home currency, or accessing what are called the repo markets. So this is secured lending from one institution to another. So, to give you an example of that, through the last financial crisis, we were sat in a hedge fund. We had exposure to Lehman Brothers. One of our other senior employees was sat in a bank. He had exposure to Lehman Brothers. Our exposure was unsecured. His exposure was secured. We ended up getting a fraction of our claim back, having engaged in an 8-week auction process in order to try to get money back. And he ended up getting all of his money back in days because he had collateral that he could liquidate. And so, a key part of this for us is providing people with access to what has historically principally been a bank-to-bank market, of saying, if my counterparty goes bust, then I've got some collateral in order to be able to liquidate that to get my money back, not having to sit at the back end of an unsecured creditor queue, which might take months, or in the case of Lehman, years. But in order to do that, you need vast levels of financial infrastructure. So In the case of just buying securities, you need things like custody accounts, dealer relationships, Bloomberg terminals, and then of course you need risk management frameworks to put around all of that as well. So it's not just a physical infrastructure, there's kind of a cultural infrastructure piece. And then when you look at the reverse repo market, well then you get into collateral management systems and tripartite integrations and long legal agreements. And so it's a pretty heavy lift in order to put this infrastructure in place, which is why historically it's been the preserve only of kind of the largest financial institutions. And what we're doing is changing that and enabling everybody to have access.
Right. And so that means that you're not just, therefore there's not just banks that are able to access FTFs, like the sorts of products I would imagine would be stuff like gilts and US Treasury bonds, but also I guess there are different products that these companies can now access?
Yeah, so really for us, products fall into three verticals. You've got the government space, you've got the bank space, and then you've got the corporate space. Mm-hmm. And then within that, you've got some subcategories, if you like. So in the government space, for instance, we're just launching our first UK local authority fixed term funds. So this is providing the opportunity to place cash directly with a local council. As if it were a term deposit with that local council, exactly, which is kind of topical in the current climate when those councils are responsible for handing out grants and loans and what have you to their local communities in order to provide support around COVID. Of course, they need financing on the other side of that. Mm-hmm. And so whether it be providing access to the UK government, that's also going to need to raise huge amounts of money in order to fund its response to this crisis, or indeed providing it directly at a local level. In doing so, not only are we helping people to diversify and reduce risk on their cash, but we're also opening up a new funding channel for those government entities in order for them to raise funding, which will be good, hopefully, for all of us in the long term, because it will mean we borrow less money, which means we will have to pay less taxes. And then so you've got that's the government space. The bank space, as I mentioned, you've got secured and unsecured. We only offer unsecured very selectively, and we do that with very highly rated institutions. And then you've got the corporate space. And this, again, is also relevant in the current context of the current climate, because you've seen an awful lot of corporates tapping revolving credit facilities from the banks, but also tapping government loans in order to provide liquidity. Through our platform, they can access a totally new source of liquidity, a totally new set of clients through issuing fixed-term funds throughout that platform to our client base.
It's what was sort of required from a build perspective in order to get you to the stage where you can perform these kinds of activities now?
Yes, I guess there are three major bits of build. There was an operational build, which I've talked about a bit, which is putting in place all of that financial infrastructure. And to be completely frank, we're still building 3 years on. We have huge amounts of financial infrastructure in place now. And by the end of the second quarter of this year, from a financing perspective, we'll have comparable financing infrastructure to most major banks within the confines of a fintech. But there's always more to add on, and we're continuing to build that the whole time. Then you had a legal and a regulatory build. So unlike most tech companies, we're also a regulated asset manager, because we have to be in order to manage our fixed term fund platform. Right. And so in order to do that, we had to come up with an entirely new legal instrument that was a combination of kind of legal regulation, but also tech, because we knew that we needed to be able to issue these instruments, what we call fixed term funds or FTFs. Mm-hmm. We needed to be able to issue them on demand and at zero marginal cost. Yeah. So we had to understand how did the legal requirements and regulatory requirements play into what we were able to deliver from a tech perspective, because the sort of the feedback that we got over the years was what we needed to deliver something that was super standardized, super simple, and also really lightweight from a cash investment perspective, because most of the people who we deal with, either placing cash or raising cash, is only a small portion of their job. They have a bunch of other things to do as a treasurer throughout the day. And so it needed to be something that was really quite low touch, which was quite a challenge, taking hugely complicated financial infrastructure and turning it into a few clicks at the end of the day.
Yeah, I guess a point and click version of what is a pretty complicated sort of set of financial procedures within most companies. That sounds complex. Well, we'll kick off now by taking a look, I guess, at the first interaction that TreasurySpring might have with their customers, and this will be the onboarding flows. The landing page here, and we have the sort of Google sign-in portal, and then also an email entry point. So you're just there showing us that both sections can be accessed quite simply, and then really quickly we're into this sort of tasks area where we can see the sort of master agreement that a user will have with TreasurySpring, I'd imagine. Is that what's going on here?
Yeah, exactly. So one of the things in onboarding is obviously trying to make that as streamlined as possible. So we produce smart forms, so people only get asked the questions that are relevant to their particular type of organization, and then we'll also pre-populate this form with all of the information we can take from publicly available sources. So they only have to put in things that we can't know, like bank account details that you're seeing here.
Yeah, for sure. And how would you typically get that sort of other information? So if you were to find publicly available, would that be via company's house or via company?
Exactly. So it'll be a combination of information that the client might have provided to us in various forms over time, but it also company's house and various other UK company data sources that we can access in order to make sure that we ask the client for as little as possible, basically.
Yeah, I guess reducing that cognitive load is real key when you're trying to get people to do something which might be considered quite complicated like this. So in terms of the onboarding being finished, that's really quick. One thing that was really noteworthy about that was that, you sort of like logged in and then were onto the platform before actually doing any of this sort of like the next sort of master agreement sort of documentation. It's quite an interesting thing, and we're going to get like a tiny bit UXy here for a minute, but like when you phase an onboarding experience, I guess, like the notion of starting off with one partial bit of interest and then sort of moving it on to the next section where maybe the situation's changed, the user's already into the platform, they can see a sort of a sense of progress has already been made. Then they can sort of, more easily process it, I guess.
Yeah, exactly. And so for us, it's, they come in, and some of the attraction for onboarding to the platform is that they get to see a whole bunch of data that they wouldn't otherwise see even before they place their first fixed term fund subscription, what have you. They get to see what's available on the platform. And so by permissioning them to see that during the onboarding process, they can come in, they can have a look around, and they can say, oh, actually, I can't click any of these buttons yet, but it's interesting that there's something real here, and there are some things that look like they might be attractive to me were I to complete the onboarding process.
What are the typical types of user that you have? Like who are the people who would typically be using this platform? And then further to that, at what stage does the sort of the onboarding flow come into your experience of dealing with this user? Are you typically speaking to the user before they get onto the platform, or are they kind of like, are they coming to this with fresh eyes, or how does that work?
In terms of types of clients, this is a fund management business platform, whatever you want to call it, for professional clients only. So what that means is people have to place a minimum deposit of £250,000, euros, or dollars. Mm-hmm. So it's not a retail product, and it's also in the context of thinking about UX, that's important as well, because we're competing with bank onboarding processes, money market fund onboarding processes, things like TradeWeb, Bloomberg, which if you've seen them all, as I'm sure you have over time, have quite a different look and feel to your average B2C, smartphone app-based UI. Yeah, definitely. And so for us, it's trying to strike a balance between something that is looks robust and feels as secure as it is in terms of the onboarding experience and the platform that's around it, but is also efficient and clean and some of those things that you'd focus on more if you were trying to build a B2C app.
Yeah, for sure.
So in terms of clients, we've got people ranging from large corporations through SMEs with charities, family offices, hedge, private equity, VC, fund managers. So it's a really broad church of different client bases. Yeah. And people use it for kind of different purposes. Some people, particularly in the current environment, are very downside protection focused. And for us, minimizing risk is always sort of step one in cash management. But we also offer some longer dated products for people to be able to go and say, oh, I can term out my cash for a month or 3 months or 6 months and earn some yield pickup for doing so. Sure. In terms of how people interact with us, typically there will have been, I think we've had a handful of cases where it's pure reverse inquiry, it comes straight through, and then people go into that journey that you just saw of their own accord. Right. But almost always, because this is a B2B platform, there will have been some material integration and contact between us and the Treasury team or the family or what have you, whatever it might be, before they get to onboarding. They'll probably also have seen a demo of the platform before they get there.
Yeah.
But it's really important that once people make that decision to say, yes, I'd like to go, that the process of getting from that yes in theory to a yes in practice is as smooth and as quick as possible.
Sure. And you expect that to continue in the next sort of product that you're going to be releasing, which is around local authorities? Do you expect that to be a similar style of relationship to the others that you have within the product?
Yeah, I think so. I think over time, we see this very much being like, if you look at, it's not a complete accident that our products are called fixed term funds, or FTFs. We took a lot of inspiration from exchange traded funds, or ETFs. And if you look at where they came from kind of 20 years ago, 25 years ago now, where they were just on one particular asset class, the first one was on Spider, the S&P 500. And then now you can buy an ETF on absolutely anything. It's a $5 trillion market globally. But to begin with, people had to understand, what is this ETF? How does it work? What's the mechanisms around it? How do I get my money in? How do I get my money out? Who provides them? Whatever. We're in the early stages of that journey, which is where people have to understand what a fixed term fund is, who we are as a firm. And so naturally, that's a much higher touch sale than it is for an ETF now, for instance, where people go, oh, it's just an ETF on the FTSE, I'll go buy that. We anticipate that over time, we'll get to the same place with FTFs. But that's obviously a journey that is unknowable exactly how long it takes, and it's not going to happen this year, and it's probably not going to happen in 2021 either.
We're in it for the long term, I guess. In terms of the kind of current climate and the current sort of processes that are going on at the minute, in terms of people moving or companies moving their money around a little bit more as a result of what's going on with the virus, would you anticipate a kind of uptake in different types of people signing up for the product? And have you experienced anything like that so far since this crisis sort of began?
Yeah, absolutely. So I guess naturally economic crises bring counterparty risk into focus much more. And so people suddenly start to think, okay, I've got all of these funds, where are they? On the cash investing side, and are they in a safe place? Am I comfortable with them being in Challenger Bank A, B, C, or wherever it might be? Yep. And so given that we cater in the first instance to helping people to lower risk, then we've seen a lot of people come with that as a particular focus for them. I think we'll have onboarded more people probably in the 6 to 8 weeks since this whole thing began, certainly, than in the previous 6 to 8 weeks from the beginning of the year, which you wouldn't necessarily assume to be the case given the working from home tech challenges and what have you that people have had. So definitely seeing increased interest from that. And then, of course, the other side of the coin is people being interested to borrow. And so in an environment like this, again, we see more demand for people trying to say, okay, what are alternative sources of financing? Even it's not just the case that people say, oh, I didn't have any financing, maybe now I get a TreasurySpring. But they're saying, I've got my revolving credit facilities, maybe I've even got a commercial paper program, but actually now more than ever, I want the ability to diversify. So if there's effectively a free route for me to go and access an entirely new pool of people, why wouldn't I explore that?
Yeah, naturally. Yeah. Cool. And so when these new users that you've had on, and that a typical user would go through this onboarding flow, would they be expecting to be able to execute a trade straight away? How soon after onboarding would there be the ability to sort of start playing with the money?
So it very much depends on the type of client that you've got. So if you've got a client that's regulated, then they will. We can do simplified onboarding, and actually, to give you an example, there was one I think that came through this morning, FCA regulated client. I would expect that they'll be fully onboarded by this time tomorrow, because it's a relatively straightforward process for us. Obviously, the more complicated someone's holding structures and the more questions we have to ask, if they're from a particular jurisdiction which is deemed to be high risk by the regulators, that process can take a little bit longer. Right. But you're talking on average probably 2 to 5 days to onboard versus we're going through the onboarding process with AN Bank, which shall remain nameless, for our own funds at the moment, just as a normal business bank account. And I think 2 to 5 weeks would be wildly optimistic in that case. So it's trying to change an order of magnitude of onboarding. And also bear in mind that for us, you onboard once, and that gives you access to everything that we've got on the platform today, as well as everything that we bring onto the platform in the future. Whereas obviously if you onboard with a single bank or a single fund provider or what have you, and you want to go do another one, you have to do it all over again.
Cool. So the next step that we're going to look at is the actual execution of the investment. First thing to note is we've got this little drop down, which I guess gives us the name of a few names of businesses.
Yeah, so ultimately you could be onboarding for multiple different entities, and then you can execute on behalf of each of those entities.
In different currencies. Okay. And then here we've got the top level, we've got, I guess, some dot visualizations of different funds, and then a list here with a modal there producing some of the information on what was in those funds, and then the term, that's sort of the more interesting part. You see sort of like treasuries, and then but quite a lot of diversity in the different terms of these funds. I guess that's one of the interesting elements of the FTF market, is that like repo markets, I always thought of repo markets as like overnight markets, but these are sort of, I guess, anywhere stretching from 1 day to 75 days or something like that. Is that right?
All the way out, you can go all the way out to a year or 2 years actually.
Right. Okay. And then we've purchased there, and we can see here a list. So anything. So what's the key bit of information there? It's a really quick subscription form being delivered via email. I guess that's just a form of verification for you there, so you know what's going on. And we can see that.
Yeah, I mean, interesting to note here that what you saw there was somebody going through choosing a fixed term fund, putting in the amount that they want to send. Often, because we're dealing in millions or tens of millions in terms of the volumes that people are placing, they'll want an audit trail and they'll want an approval process. So you can see here that at the bottom, this has captured the digital signature of a pre-authorized user. Mm-hmm. And then people can set up in the onboarding process whatever approval metrics they need. So it might be that Jim can input but Kevin has to approve, or vice versa, or it might be that Jim and Hannah can both input but Kevin has to approve. You can set up kind of whatever tree structures you want in order to match people's internal investment guidelines.
Okay.
And then also, other thing that I think is really important is one of the reasons that I mentioned earlier for people not doing this stuff themselves, other than just the pure infrastructure lift, is risk management. So if you were to put in place the infrastructure to say buy UK Treasury bills, then putting in place a risk management process to ensure that your treasurer or your cash manager or whoever only buys UK Treasury bills and doesn't suddenly get access to thinking that, I don't know, Apple stock looks cheap today, and so I'll go place my cash in that. Okay. It proposes a whole internal risk management challenge. Whereas when you come into our portal, you can set up your investment guidelines in whichever way you want. So you might have seen on the journey there that some of the fixed term funds, there was no subscribe button next to them. So we can set it up in multiple ways. So if a client says, I want to only ever be able to purchase fixed term funds from an underlying issuer with a credit rating of X, with a maximum term of Y, and in maximum or minimum increments of Z, then that can all be hard coded into the platform so that your CFO or your treasurer or what have you can know with confidence that the only thing that is going to be able to be executed through the platform with the firm's money are things that sit within the investment guidelines, rather than, so you create that walled garden, that comfortable risk management environment for people to transact.
Okay, and I guess that goes into the sort of the one of the earlier points we're mentioning, which is that these are as you mentioned there with like Apple stock, for example. This is not the kind of thing that you guys want to invest in. Part and parcel of the point of investing in these fixed term firms, fixed term funds, would be that you would have the ability to make sure that you're investing in more safe or more potentially durable assets during this time. Is that
yeah, exactly?
So it's, I guess, an extension of that mindset.
Yeah, for sure. And just giving people, most of our clients will have bank deposits. A load of them will have some money market funds, and we sort of see fixed term funds as the third leg on that stool. And depending on what economic environment we find ourselves in, we very much want to be able to just offer a menu to people. We don't tell people what to buy through the platform. We appreciate that everybody has different views of risk. Companies have different cycles. And so for us, our aim is just to offer people what we believe are the best risk-adjusted cash management products at any point in time. And if people want to go at the very lowest end of that risk spectrum, or within what is still an exceptionally low-risk part of the world, dial up just a little bit in order to try to earn a bit more return, then again, we just facilitate that for them.
Is there sort of any other sort of like legal requirements for, purchasing assets like this? Or have we taken care of all of that at onboarding stage? Is there any other hurdles or loops to get over before you move a chunk of...
No. So again, that's some of the design, not just from a tech perspective, but from a legal perspective, was that you'll have seen in the onboarding journey, scrolling through the sort of terms and conditions, if you like. Yeah. Within those terms and conditions are that's the contract that the client signs with us. And that's sort of the overarching legal relationship between us and the client. Yeah. And then on the platform for each particular product, there are two other documents. One's called a fact sheet and one's called a sell operating procedures. And really they just set out the very specific nature of a particular product. So who is the underlying issuer? What legal documentation sits between the platform and the underlying issuer? Which bank account do I need to send my money to? But it's all for information purposes, really. They form part of the contract, but there's nothing else that needs to be signed or what have you. So everything's self-contained within the platform for clients to be able to say, okay, I'm interested in... They do the filtering, as you saw, as to what might be interesting here. They click on something, it brings up some basic information, and then they can, if they want to go and get more information in terms of getting down into the detail of exactly how it operates, and then ultimately want to onboard, and so need to know where to send the money to, all that information is contained within the portal as well.
Great. And then finally, we're going to take a look at the portfolio holding. And in this area, we've got different funds split out into different currencies, and there we can see pending. I guess they're filtered by a currency. A lot of filtering options here. I guess you're trying to provide a lot of filterability there. And then also rolling over the maturity. We've got the redeem option there. We can hold and we can auto roll. And I guess you can talk a little bit about what those different options mean.
Yeah, so ultimately, one of the things that is useful from a client perspective, two real functions in this screen. One we're seeing at the moment, which is splitting. So that's saying I might have placed a fixed term fund here for 7.5 million. I now want to I don't want to take the same action with all 7.5 million. I want to split some of it. So I want some of it to automatically roll, and I want some of it to redeem. The first bit of that, though, is people saying, well, actually, you know how it is if you place a term deposit, even in our personal lives, you place a term deposit through your bank and then you forget, and ultimately you realize that the bank's rolled you into the zero yielding or the worst possible yielding account that they could have. In our world, that stuff is ever more important, which is people want to know, okay, I'm placing this for a fixed term, whether that be 2 days or 2 weeks or 6 months, but I want to have the option to either have a very low touch solution, in which case they just select to auto roll. And that means if I've placed a 2 week on maturity, they'll get a notification 2 business days before the maturity date saying, you elected to auto roll this. This is, if you don't do anything, we're now going to automatically roll this new fixed term fund, which is going to mature on X date at Y indicative yield. And then the client can just sort of look at the notification, say, yeah, great, that's fine. I'll just allow it to continue to roll. So super low touch. Or clients can say, I'm doing this for a particular purpose, which is I've got a dividend date coming up, or I've got tax payment date, or there's going to be some acquisition we're looking to make. So I really want to place it for a totally fixed term, and I want to set it to automatically withdraw or redeem at the end of that period.
Okay.
But often the truth is somewhere in the middle, which is I was rolling this 10 million, for example, but now we've now got a bit of capital expenditure we need to do, so I'd quite like to take out 2 million. And so through the platform, again, that was where you see the split of holdings, and they could say, I just want to set 2 million of it to withdraw. That money will then go straight back out to the account that they subscribed from, and the other 8 million would just continue to roll. People can also split and move from one product to another product, for example, or move from one shorter roll to a longer roll. So it's trying to really provide as much functionality as possible, but keeping it as simple as possible from a UI perspective.
Sure. And as sort of noted in the walkthrough, there's a lot of filtering options, and we've got there on that particular list, there was a lot of holdings in different currencies and things like that. How many sort of like of these investments would you typically expect a company or to hold on their portfolio?
So on the demo portal there, you're seeing more than we would typically expect for any individual company.
Yeah.
You will have situations where you might have, per the options that you saw in the previous journey, you might have multiple companies within the same group. So for instance, we have one fund manager currently in the process of onboarding. They have 5 different funds. Okay. And so across those 5 different funds, they might have 3 to 5 fixed term funds each, which would lead to them having 15 to 25 in their portfolio if they look across the whole lot as a group. Yeah. For the most part, people will often do something that is shorter dated and a lower touch, and then maybe something that is longer dated and slightly higher yielding. Mm-hmm. So sometimes people will also ladder. So they might say, I want liquidity rolling off every single week, in which case they might have kind of 5 to 10 over a 5 to 10 week period. So it's a mixture.
Yeah, yeah. And would you, and we also saw like on those, especially with, I think it was in the dollar holdings that we had there, we sort of like these extended sort of timeframes where, the repo market might hold on to money for one day. And as you said there, it might be up to a year. What would typically be driving those sort of dates, the date ranges of these different holdings?
So, I mean, particularly in the current environment, most people are nervous about future liquidity, and so what we've seen is weighted average maturity, which is kind of the metric we use for how long people are placing their cash for. So it's come right in as people say, I just want to keep it short and be able to access it regularly if I want to. Yeah. Generally, people tend to use longer term for places where let's say, give you a live example, we have a large intergovernmental organization that receives its funding, and actually it might invest those funds out over a 5 to 10 year period, but and so it's got pretty good visibility, and it knows that it's never going to need more than X percentage of its cash within a 6-month period. And so given that, to the extent that they can get comfortable with the credit risk, typically, I'll call a normal environment, you'd expect to see an upward sloping yield curve where you get paid more for terming your funds out for further. Now, given that we're at 0 right now, hopefully we'll only see an upward sloping yield curve, although it's still anybody's guess. But that's generally the reason. It's terming out in order to earn a yield pickup. Now, again, right now, were people comfortable terming out on an unsecured basis to get that yield pickup? Maybe not so much. But if you're going to term out on a secured basis, well, that feels like a slightly better place to be, particularly because through the repo market, you've got an independent third party that's marking your collateral to market on a daily basis. So you know that even if your counterparty gets in trouble, you've got some collateral there that is worth the amount of your loan, ideally more, every single day. So that encourages people to take greater term.
Great. It's fantastic. Cool. So just a few final questions just to round off. Obviously, 2020 has been a very difficult time on sort of the oil market prices, and also with the particular sort of rollout that's going to happen off the back of COVID-19 and the reawakening of the economy. What are you expecting from for the rest of 2020, specifically for TreasurySpring, and I guess maybe a little bit more wider as well?
Well, sorry for being a bit depressing here, but we're fixed income people at heart, and unfortunately we're pretty bearish on where we think that this rolls out from an economic perspective over the course of the rest of this year. Sure. I think it's really difficult to see how you end up with quite such high levels of unemployment and quite such high levels of economic slowdown for an extended period of time. And I think everybody now accepts that this isn't going to be a 2 month or a 3 month, whilst hopefully we'll start to get things back open from next week. I think it would be crazy to assume that economic activity is going to pick back up to anything like where it was in Q2, probably not in Q3, and who knows beyond that. And so given that case, and given that central banks won't support everything forever, our base case is that you start to see real credit deterioration in the second half of the year as businesses that were highly levered and had thrived for a long time on cheap debt and a very globalized economy start to struggle a little bit. So very difficult to see where it ends, but from a sort of economic perspective, we feel very much like we're in a bear market rally right now, rather than anything that approaches the magical V-shaped recovery that people talk about. For us, I guess we are counter-cyclical to a large extent. As I mentioned right at the beginning, we built this business off the back of the last crisis, very much looking at what happens in the next crisis. We want to provide people with the opportunity to earn the best risk-adjusted returns in the good times. But we also want to provide people with the absolute safest place to store their cash in the more difficult times. So, we continue to see increased inflows. We continue to see increased onboardings. We're onboarding larger and larger clients all the time, and we expect that to continue. I guess, bigger picture, we also probably expect that the era of companies running super lean in order to distribute all of their funds to shareholders, borrowing money to engage in share buybacks, is probably behind us for some time. It doesn't look so good when shareholders have been paid out billions of dollars in dividends over a relatively short period of time, and then companies come cap in hand to the government saying, "Oh, we've run out of money, please can you help us out?" So I think that we're going to have a move towards kind of resilience rather than efficiency, something that really drives the way that people run companies. And I think that will lead to higher cash balances, which naturally leads to a question of, well, what do I do with those?
People just starting out on building out technical products. Obviously, you've been building a tech product now for a few years. What sort of tech product would you be building now if you were just starting in this current climate? And B, how would you advise people who are building really complicated products like yours?
So I think the key is simplicity is very much the biggest lesson that we've learned over the last several years. We've seen lots and lots of platforms with beautiful UI and wonderful functionality, 80% of which is never used. And sort of all of the feedback we had from our clients as we were going through building this was, keep it as simple as you can. There are only a limited number of things I need to do. And the most important thing is that I can kind of pick it up with anybody on the team and they can go and use it. The other thing which we didn't really talk about, but is distribution. And I think today and going forward, engaging in the right distribution partnerships and building your product in a way that can integrate as effectively as possible with those distribution partners, no matter what business you're in, is really important. So we were clear that we wanted to build a simple API, which we could use to power our front end, which we sort of talked a little bit about today, but also we use that API to point at other integration partners. And so obviously in a world where people have more and more technology, they have the technology that they like, trying to get them to use a new platform isn't always easy. But if you can do something that's integrated with an existing ecosystem that they're already happy with, then it can be so much quicker and so much easier to get that client. Now, that obviously comes at a cost. And from our perspective, you have to be able to offer both options. But having that flexibility to say, okay, I've found a distribution partner over here who has a large pool of potential clients, and I know that I can do that integration, but not just do it on a one-off basis, do it in a replicable way, which means that we can then go and do that with somebody else who looks a bit like that distribution partner, creates that internal leverage in the system that hopefully enables us to grow nice and quickly.
Yeah, and I guess it's as Chris Adelsbach, who we both know, says, it's more around what are these sort of like already oven-baked solutions that are already out there, and how can they work with each other in order to sort of provide the right tool for the right time, I guess, and that speaks into this distribution thing. Cool. And one final question before we go, Kevin. So if there's a business out there that wants to kind of work with TreasurySpring or to invest with TreasurySpring, what should they typically do?
Oh, so the easiest thing is to either people can feel free to reach out to me directly or any other team on LinkedIn, or just come to the website. There's a brochure download request button, and we'll be straight back to you.
Great. And obviously it's really important in these times that people are moving towards safer assets. So great that TreasurySpring is there to help people. Thank you very much.
Thanks very much for the time, Jim. Appreciate it.
That's it for today. Thank you so much for tuning in. Stop by next week for more insights and journeys. If you want to see more of Pulse, the product that underlies this product, then please go to pulse.11fs.com or drop us an email at 11fs. Pulse on Twitter, pulse@11fs.com. I hope you enjoyed that episode with Kevin. As you can see, that's a really fascinating range of products available for institutional investors that might not necessarily have access to these really safe assets. Now, in these times more than any other, and especially quite excitingly if you're a local authority, having the money to be able to invest in safer assets, it can seem like a blessing and a curse if you don't have the access to those safer assets. So TreasurySpring are doing a really great thing here. Definitely want to talk about more going forward. Thank you, and we'll see you next week.